intuitive payroll software. They're easy to learn, easy to use, and tailored just for you.
With PatriotSoftware.com, accounting and payroll, keep your time and money.
Go to PatriotSoftware.com today.
I had such anxiety. Sometimes it felt like I couldn't breathe. Fortunately, one of my friends told me,
"You've got to relax. You're going to get yourself sick."
This is Scribd, an app that gives me access to ebooks, audiobooks, podcasts, and more. With Scribd, I can get my steps in countless pages. Scribd makes every moment a reading or listening moment. Go to Scribd.com and try it free for 30 days.
24 seconds away from the opening bell in New York. This has been a messy one this week for the Nasdaq. Down about 4.5%, pushing 5 percentage points lower. This morning we're down 0.7%. We're negative more than 100 points. So the S&P, we're down about 16. We're down 1/3%. Let's see opening bell, switch on the board and get to the bond market. This time yields aren't higher. They are lower by 5 basis points to 175. Talked a lot about this through the morning so far. As this bond market breached that limit where it starts to become self-limiting, it hits financial conditions, the equity market, that flows back into a bid. Maybe, or maybe this has just paused and there's more to come. That's the view of Bank of America. This rate shock, in their view, is only just getting started. The euro's firmer, dollar weaker, euro dollar 113.56, up 0.4% there. On crude, 84.87, we are negative by about 0.8%. The only opening price you all want, I know, it's Netflix. Have we got an opening price? I think we have, so let's get it up very quickly. We are negative 22% on Netflix this morning. It is the stock of the morning, without a doubt, down 21.6% and jumping all over the place. Let's get to Ed Ludlow for a whole lot more. Morning, Ed.
Good morning, John. That's the biggest drop, by the way, since July of 2012. Netflix, a very different company in July of 2012, the stock lowest since April 2020 at the start of this pandemic. Several Wall Street analysts have cut their price targets on this stock, obviously. You know, the 2.5 million net subscriber adds for the first quarter in terms of what they guided was half of what the street was looking for. And executives kind of pursed a number of things to do with that. Growing competition, right? The changing macro environment, economic pain in key markets like Latin America. I think you're a big Bridgerton guy, right, John? And the second season is coming in March. So that's late in the quarter. So executives tried to spin this as being, well, the content slate is pushed out. We'll see some new subscribers come in late in the quarter, hence the downgraded outlook. But that's only half the story. Let's look at margins. Come with me into my Bloomberg terminal, because subscriber acquisitions were below what was expected, right? Margins, operating margin falls to the lowest level since 2018. And then you look at the guidance for full year 22. Operating margin of 19 to 20%, but they're really impacted by currency headwinds, right? Strengthening dollar will hit revenue by in terms of $1 billion hit in 2022, but also 2 points of negative impact on the margin. This is a company that doesn't hedge, by the way, when it comes to currencies, and they get 60% of their revenue outside the US. So there's a lot going on here to look at. And it just raises the question of the week. Is this the end for the pandemic era stay-at-home stock winners? You and I have been on this show for 18 months talking about stickiness. How sticky are these stocks? That's a 2-year chart. You can see we've given up most of the gains of the pandemic era. But stickiness doesn't seem to be the issue, John. The issue that Wall Street's pointing to is, where does growth come from when the pandemic goes away? And why have we not returned to pre-pandemic growth levels?
Bridgerton. Who invited Ed? Who watches Bridgerton? Ed, final questions. You knew you'd... Come on, buddy. You know me better than that. $200 billion name, Ed. Yeah. How on earth did corporate guidance and the street get so out of whack?
Yeah, it's interesting. I mean, what's so surprising about this is I've been looking at data from Paris Analytics. They look at market share. And we knew by December that you have the likes of Amazon Prime, HBO Max, Hulu, already taking significant market share from Netflix. You know, they're seeing literally a 10 percentage point drop from where they were at early in the pandemic. So we kind of saw this coming. But the other thing as well is that the economy is different, right? Some places are opening faster than others, and the sensitivity of households is changing. If you look to emerging markets like India, they kind of seem to have got their pricing wrong there, where spending power is much less. So they are having a little bit of rethink on the product as a whole.
Ed, thank you, buddy. As always, from the West Coast, a good friend of ours, Ed Ludlow. That stock is down by more than 21%. As Ed points out, if we closed here, it would be the biggest one-day loss going back to July of 2012. Tech earnings kicking off over the next week. Then we'll hear from Apple. This is the line that we got from Loop Ventures. They say the following: brace yourself. These results cast a shadow on the rest of tech. Until Apple reports and we hear from the Fed, the tech market will be on edge. Back with us, Gargi Chowdhury, Jay Pawlowski. Jay, I want to come back to you. I want to get the view of both of you, actually. When you see a name like this get hammered the way it's getting hammered in the market this morning, Jay, is there a lesson from that, a single name story for you, or something broader?
No, I definitely think it's part of something broader, John. Look, these types of names, the thematic stuff, the ARK, have been decimated for months. They peaked back in February, almost a year ago. I think a real question, and we've touched on it before, is whether this is the beginning or the end of a bear market, not for the work from home. Work from home, I think, is over. Haven't been a fan for quite some time. I think the bigger question is, we're talking about build back smaller. If we get the climate package, does that give the thematic segment of the market a lift? ARK, for example, has round-tripped completely. It now trades for roughly the same price-to-sales valuation of the NASDAQ 100 with double the revenue growth of the NASDAQ 100. So valuation, technicals, market sentiment all suggest to me that if, as I do, one believes that the growth coming out of COVID, when we get through COVID and we start to see what does the world look like, if it can be better than the pre-COVID 2 inflation, 2% growth, which I think it can be, arguably these types of names, not necessarily the Netflix, but some of the thematic, disruptive tech, innovation, climate-specific stuff, are the things that are going to be the opportunity set. And so to me, that's where I'm looking, watching ARK carefully, watching some of the thematic stuff very carefully, as well as our previous focus on value and non-U.S. equities. I think the opportunity here is to start sifting around some of these segments, some of these thematic innovation type names that have been absolutely hammered. Down 20%, John. I've seen that repeatedly for months in a number of segments of the market. This is nothing new.
Gargi, your take on that, to the same question, please.
Sure. So I think we have to look past the reopening and the stay-at-home story and looking ahead for 2022, the story is going to be about one thing, which is around margin resiliency and pricing power, and what companies are able to do that, pass on higher prices, and what companies aren't. So that's what we're going to be focusing on and really looking at those companies, those quality companies that have that pricing power. The second part is, you asked Jonathan around, is this the beginning? And I would say that, there is a huge amount of awkwardness that's going on with the Fed right now. I mean, they're still buying bonds. Then after that, they're going to raise rates. Right after that, they're going to do something with the balance sheet and start beginning the unwinding process. So I think that the market often has shown us that they don't like that type of volatility from the Fed. So while we still sort of get some of these motions in place, I think we can see a little bit of volatility in the markets. However, what we have to keep in mind, which I think the previous speaker was saying as well, is that we're looking at extremely good levels of growth. We're looking at a labor market that's incredibly strong. We're looking at wages picking up. We're also at the same time looking at a lot of cash that's still sitting on the sidelines in money market mutual funds. So the prospect here for the equity markets remain pretty strong. I mean, we're still at negative real rates, even despite the move that we've seen year till date. It's still negative. And compare that to the, the 2% era of positive 2% real rates. So this is not a market that can, stay down for very long, but certainly some volatility to come in the near term.
Everything you just said is at the epicenter of Jay's call. This is what Jay's talking about. He believes that real rates will remain negative, that trend growth will be higher than you think it will be. It will be above 2% for longer than you think it will be. And for that reason, Jay still likes this equity market. We've got a ton of earnings coming up over the next week. IBM, Microsoft, Apple, all on deck. Let's get to Kaylee for more. Hey, Kaylee.
Hey, John, we'll put together Microsoft, Apple, and Tesla, and what you get is a collective near $6 trillion in market capitalization that reports over the course of next week. So this is a lot of weight, and that weight has been a big drag to the downside so far in 2022. Microsoft, for example, is down about 10% over the course of the year thus far. Tesla by about 7%, Apple by about 6%, and all said, that contributes in a big way to the decline we've seen in broader technology, with the NASDAQ down about 10 percentage points, as we know, in a technical correction. So the question is what the these reports of these companies will do, not just to their trajectory, but really the trajectory of tech more broadly and the broader market. As for what the reports are expected to look like, we are expecting growth in the technology sector to slow on both the top and bottom line. For that top line revenue number slowing from 19.2% in Q3 down to 10.4% expected in this reporting season. Then when it comes to earnings, from 42.3% down to less than 14%. And that is expected to continue to decline as we move forward through this year and the comps get a lot tougher. So it's kind of a dual challenge for these technology names when you're faced with the prospect of slowing earnings growth. At the same time, we're seeing yields moving higher, calling into question some of those higher multiples that investors have to pay. That already has led to a major exodus of growth stocks, which are lagging value stocks by a margin of about 8 percentage points so far this year. And you can see value there in white gaining ground against growth as yields head north. So we'll see if this rotation gets reinforced by earnings or starts to turn the other direction after them, John.
Kaylee, thank you. Let's turn back to Netflix as well. This stock down by 22% now in early trading, the biggest one-day move we've seen going all the way back to July 2012. That note I mentioned is from Stifel. They call it Schitt's Creek. I think you get the pun there. They keep a buy. Here's the quote. I'm not sure if you're in the mood for fun this morning if you long this name. We maintain our buy rating on Netflix as we continue to view it as the best positioned asset in the space with ample headroom to capture market share, execute on its strategic initiatives, and deliver consistent margin expansion. That's a name right now that's sub 400, 500 price target, down 22% on the day. Jay, it's a tough one. I want to talk about this with you, just the psychology of being an investor. A lot of people who come on a show like this will talk about buying the dip. Then you'll get a 10% correction on the NASDAQ 100, and all of a sudden buying that dip doesn't sound so easy. Jay, walk me through your approach to markets when you think about those issues, because I think for a lot of people it's not just about the numbers, it's just about a feeling, a sentiment, a feeling that keeps them away sometimes and away too long.
Well, I think, John, you got to have a framework. You got to have a process. I've been doing this for over 30 years. The other thing that's nice to have is a wide ambit. And, you know, my focus is global macro and multi-asset. So we can look outside the United States, and we are. We think there's tremendous opportunity in the developed ex-US markets. We can look beyond tech. And beyond growth, and we have, and we've been early, and you and I know that. We've talked about this for some time. Cyclicals and value, energy, financials, not just in the U.S., but also in Europe and further abroad in Japan. You have the opportunity to look across assets, so not just equities, but also bonds, which have been a place for us to take a significant underweight and use that cash elsewhere. And part of the place where we put that cash is in commodities. And commodities are up 10%. And when you put the things together, it tells you with rates going higher and real rates going up, okay, so it's not an inflation fear, it's growth. With commodities going up, that's reinforcing growth. With the dollar typically weakening as the Fed tightens, significantly jumpstart flows out of the U.S. into the rest of the world. That suggests to me that we have this area of opportunity that one of the worries is, are we in like 2018, okay, where I had the same view, look outside the U.S. The Fed tightened and we got crushed and it was a mistake. Today, there are differences. What are the differences? We're starting out at a early cycle, not late cycle like we were in 2018. We also have that high nominal growth, 5 to 7%, not the 3 to 4% we had in 18. We have negative real rates, not the positive 2 that our other guest was talking about. And we have a weak dollar. So I think you can make the case through a process of this is a different outlook. We have a CapEx boom, an infrastructure boom coming down the road, not just in the U.S., but also in Europe and globally. Climate is a global issue. And I think we're setting up for an analog like the second half of the 1990s, the last CapEx boom, productivity surge-driven economy in the U.S. And the difference this time, John, it's global.
Some people think we're coming out the other side of the 1990s. Jay, we can continue that one another time. Gargi, I wanted to give you the final word. The final word, please.
I would say to your question, what type of an investor are you is one that comes to mind. So if you are looking for a day trade, yes, I think there's going to be volatilities, but hopefully most of us aren't looking for that quick day trade. And I think if you can be a little bit more patient with these markets and look at the macro, look at that growth story, look at the labor market improvement, look at so many of the other positive factors such as the negative real rates that still accompany us, I think think you're supposed to stay invested in the markets, certain sectors of the market, certainly the value and quality that we talked about earlier, and I think that is going to pan out. But if you're looking for more of the short-term gains, I think that in these volatile environments, that could be hard.
Gargi, brilliant, as always. Gargi Chaudhry there alongside Jay Pilowsky. Netflix right now down 22% in early trading. Coming up, the US and Russia agreeing to continue talks as tensions over Ukraine simmer.
If there was ever a time to test the resolve of Europe and the United States when it comes to enforcing borders and other measures, now is that time.
That's next. This is Bloomberg.
This is Bloomberg's The Open. I'm Kriti Gupta. You're looking at a live shot of the principal room. Coming up, Pat Gelsinger, Intel CEO. That conversation at 4 p.m. Eastern, 9 p.m. in London. This is Bloomberg.
My guess is he will move in. He has to do something.
In these kind of circumstances, we have to be ready for everything.
If Moscow chooses the path of further aggression, we will impose swift and massive costs.
The Russian side is aware of our determination. I hope they also realize that the gains of cooperation outweigh the price of further confrontation.
Any use of force against Ukraine will be a severe and serious strategic mistake by Russia, and it will have severe consequences, and Russia will have to pay a high price.
It is going to be a disaster for Russia if they further invade Ukraine.
The US Secretary Antony Blinken and his Russian counterpart Sergei Lavrov emerging from meetings today with little resolve, the US pledging to continue talks.
This was not negotiation. but a candid exchange of concerns and ideas. Following the consultations that we'll have in the coming days with allies and partners, we anticipate that we will be able to share with Russia our concerns and ideas in more detail and in writing next week. And we agreed to further discussions after that.
Joining us now to discuss is Bloomberg's Maria Tadeo in Geneva, where those talks took place, and Anne-Marie down in D.C. Maria, let's just start with you. What did we learn today from both Secretary Blinken and his Russian counterpart?
Well, here's the thing, John. We did hear from both sides. They both say they will continue to talk. In some extent, that could be good news. It buys time for everyone. It also shows that an invasion into Ukraine is not imminent, particularly after the Russians said that the U.S. will present some proposals on paper next week. And potentially, there's a lot of speculation, especially on the Russian side, that we could see a meeting between Vladimir Putin and President Biden. Nonetheless, when you look at the issues, not a lot changed. You did hear from the Russian Foreign Minister Sergei Lavrov saying, we don't want to invade Ukraine, we don't want to hurt the Ukrainian people, but we do know there's 100,000 men that are stationed in the Ukrainian border, and of course are ready for combat. On the other side, of course, when it comes to the United States, they were also clear that sanctions are still very much on the table. But to me, John, the bigger question here is the future of Ukraine. What Russia wants, which is a guarantee that Ukraine will never leave its sphere of influence and will not join NATO, that is something that the West simply cannot accept. So where we go from here, to me, is still just as unclear as it was this morning.
Anne-Marie, you have been in the room with both of these leaders, with Vladimir Putin in the past and again with President Biden more recently. What are you expecting and how are you expecting this to play out domestically here at home in America?
Well, speaking of being in the room with both these leaders, Jonathan, we should note that Secretary Blinken alluded to the fact that it could be on the table, another summit between President Vladimir Putin and President Biden. What I expect here at home is the president is going to remain forthright in his characterization of what Russia is doing and the fact that if Russia was to invade, there will be serious consequences. And he wanted to reiterate that looking down at a piece of paper yesterday before he went on an infrastructure event. There is one development, though, Jonathan, we should talk about it. It's a Bloomberg News story from our colleagues Nick Wadhams and Alberto Nadelli, and that is the fact that the U.S. is preparing to potentially extract American citizens and those personnel out of Ukraine. Now, while the U.S. government likely say, well, this is prudent, given the fact that they do think that Vladimir Putin could invade Ukraine, it does certainly seem like that looks like the direction of travel when you have the U.S. government potentially out with an announcement in a few days that they want American citizens home and out of Ukraine and out of harm's way.
The team coverage continues here on Bloomberg TV and on Bloomberg Radio. Anne-Marie Hordern down in Washington, D.C. Maria Tadeo over in Geneva, the scene of these talks today between Secretary Blinken and Foreign Minister Lavrov. The story of the moment in the bond market, yields are lower by about 5 basis points on 10s to 175. In the equity market, we are lower, much lower. Let's get you some sector price action with Kriti Gupta.
Morning, John. We have to talk about simply the growth defensive position that you're seeing in the IMAP this morning. A lot of this has to do with those consumer staples really leading the pack when it comes to really what's gaining. Utilities as well are in the green. If you want to look at what's the downside mover is, those going to be energy and communication services. So your big tech and your energy both on the same idea. They're both dropping lower and lower. The idea here is that you're actually seeing a broader decline when both of those sectors really lag the broader market. If you actually look at what this is doing to those stay-at-home stocks, we know Netflix is going to be the major story, the biggest decline since 2014. Back then, the CEO had actually said they had overestimated growth, and simply that story is what is weighing on that stay-at-home index once again. It's not just today, John. Netflix, Roku, some of those other stay-at-home names, well, they've been weighing on the index broadly for about 2 to 3 months now.
Unbelievable stuff in this equity market over the last couple of days, the last few weeks for that matter. Kriti, thank you. Netflix is down. It's down hard. This equity market on the S&P 500 down about 0.6%. The Nasdaq is down about 1 full percentage point. Coming up next on this program, your trading diary from New York City, the guide to the weekend coming right up, and into next week, a Federal Reserve decision, a Chairman Powell news conference just around the corner. From New York, this is Bloomberg. We're taking some more weight off the Nasdaq. We're down about 1 full percentage point, and the S&P coming into 2022. The lowest price target on the S&P 500, 4,400. That was from Morgan Stanley and Mike Wilson. Right now, 44.52. The single name you want to look at this morning is Netflix. It's down hard, a big miss. We're down 23%, just a massive move lower. But this time, yields aren't pushing higher. They're coming in. Have we reached that point where the bond market starts to inflate the other way? A self-limiting sell-off, maybe. Yields coming back in, or maybe this is just a pause in a trend we've seen so far. A pause and a trend that will resume. Down 5 basis points on 10s to 175. On 2s, back below 1%, just a little bit. That's the price action. Let's get to the trading diary. The president discussing plans for the supply chain at 11 Eastern. Moving to next week, PMIs from the US on Monday, a Fed rate decision and Chairman Powell news conference on Wednesday, and finally, tech earnings coming throughout the week. Apple rounding it all out on Thursday. From New York City, catch me at 1 p.m. Eastern Time for Bloomberg Real Yield. A ton to talk about in this bond market. For the rest of you, enjoy your weekend. This was the countdown to the open. This is Bloomberg.
Their fingertips. They use top-fitting technology to analyze your swing metrics. And their builders handcraft your perfect clubs. Find your fit at Club Champion.
Get 50% off your fitting with a purchase of $500 or more. See ClubChampionGolf.com for details.
Last year, more homes canceled cable TV than ever before. Why? It's just too expensive. For half the price of cable, you can get Fubo TV and watch the live sports and TV you love. Try free at FuboTV.com.
Scribd is my time to listen.
I can listen at home, in the car.
It's a way for me to stay informed, get entertained.
Scribd is ebooks, audiobooks,
magazines, podcasts. Scribd, it's awesome.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day on this Friday, January 21st. Here are the top market stories that we're following for you at this hour. It is an end of an era for pandemic stocks. Netflix subscriber growth disappoints. Lockdown favorites from Peloton to Zoom lose their shine. And you had frank talks big action. Secretary of State Antony Blinken tells his Russian counterpart, Sergei Lavrov, that the U.S. stands behind Ukraine as the U.S. weighs evacuating diplomats' family members from Ukraine. And all of this means safety bond buying is back. Tech's train wreck and flare-ups with Russia put bonds back in vogue as that safe haven trade. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, when you don't know who to blame for a sell-off, you turn to the options market, and that's what Goldman Sachs is saying. $3 trillion of derivatives tied to equities expiring today. Maybe that's why we're seeing such a big risk-off.
Yeah, trying to put your finger on it really is quite difficult, Alex. You've also got the fact that it's Friday, if anybody hasn't noticed. Wow, what a week. And maybe people are simply just saying, you know what, I don't want to carry some risk into the weekend. Or they're saying, you know what, I've held on to these positions all week. I've hoped that there would be some sort of buying of the dip. It hasn't happened. Do I want to be carrying this position over the weekend, or do I want to go to the bar and enjoy myself and not worry about it? So maybe I clean out some of those positions. I think there's a whole bunch of factors in the mix here. The geopolitical story, I think, is front and center as well. We are heading for an ugly close here in Europe, like really ugly. The DAX in particular is now down by 2.5%, but the CAC is down by 1.98%. Let's call that 2%. So there's a whole range of factors coming into the mix here. Europe is being hit by the earnings story. You've got some of the big wind turbine makers being absolutely smashed today. There's some really massive price action out there. Netflix, obviously, the poster child for that. But this is our question, and Alex alluded to it. Tech is wrecked. Certainly the stay-at-home element of it is, but take a look at even Microsoft, names like that, being absolutely battered so far this year. Now, bonds were leading equities, but it now looks as if equities are leading bonds. We are seeing a bid back in the bond market, a bond starting to play their traditional counterweight role. I think a lot of people are trying to figure that one out at the moment. Clearly, we are in the pre-Fed phase. Romain Bostic joining us now to kick that around. Bloomberg Markets and the Close co-host Christina Kino, who leads Bloomberg EMEA Markets coverage here in Europe, a rates and FX specialist. Christine, I'm going to start with you. Last week it was rates leading the equity market. Now it's equities back in charge. Is this bid in the bond markets just a derivative of what is happening in equity markets? Is it starting to play that kind of safe haven role once again?
Well, yeah, I think today it is. That's definitely what we're seeing, because all of those havens, the treasuries that were selling off massively at the start of this week are the ones that are really getting bought big in today's tech sell-off. And I think it really is what we're seeing, that catalyst from the bad news from earnings from Netflix and Peloton really kicking off this risk aversion. And that's why we started the week worrying about the great big bond sell-off. We're ending the week worrying about the great big tech sell-off.
Romain, I don't envy your job. I used to anchor the close also, and like when you have a day like this, you know it's going to be ugly.
Yeah.
What do you kind of prep for? Do you think we're seeing this sort of tech wreck go buy bonds? Is that it?
I think so. And I mean, you're seeing the softness. You saw basically what happened on Wednesday, what happened on Thursday, where you saw pretty strong bids come in earlier in the day, and then that completely faded later in the day once you got to the close. The idea here that the level of conviction out there just really isn't there. And a lot of folks are concerned right now about the fundamentals, how it's being eroded, whether it's by inflation, whether it's about what the Fed is going to do, or really just about some of the broader economic issues. And what Christine alluded to so far is we're still early in the earnings season, but it's been a bit of a disappointment. We're just not really seeing a strong growth. We're not really seeing strong guidance. And now the concern is that as we start to get those big cap tech stocks next week, Apple, the Microsofts, the Teslas of the world, we could hear more bad news from the heaviest, weightest members out there.
Absolutely. And this is a market that's got narrower and narrower around those kinds of stocks. Romain, do you think, though, we are going to find ourselves in a situation where, particularly for those tech names, particularly for those big tech names, as we start to see maybe yields coming back down again, that limits the damage that ends up getting done in the tech space?
I think a big game changer potentially for this market could be on Wednesday when we do actually hear from the Fed, and we're going to get, at least according to our Bloomberg economics correspondent, Michael McKee, a roadmap here as to what the Fed is going to do with regards to not only raising rates but drawing down the balance sheet. And I think the certainty, assuming that we get it, that certainty could actually maybe provide a little bit more optimism for this market. But right now the market is really trying to figure out not only what the Fed is going to do, but how aggressive they're going to be and how that affects valuations. That's why you're seeing so many swings in equities. I think it's why you're starting to see a little bit more defensiveness with regards to people buying bonds and, of course, a flight to some of the haven currencies out there like the Swiss franc and the yen today.
Can I just go to the other side here, Christine. How much of this is also potentially foreign investors coming into the bond market and buying because we've had a deep sell-off and now bonds are a little cheaper?
There's absolutely an element of that for sure, Alex. I mean, we've heard time and time again, all of these investors, particularly pension funds, really clamoring for those higher yields that they just haven't been able to get from bonds for such a long time. And so we finally got a taste of that. We're definitely seeing some signs of pensions potentially de-risking right around this time, just because we've had such a big run-up, and perhaps it's time to go back a little bit to the classic haven trades here and buy up a little bit of those bonds.
Just in terms of what the expectation is for next week, where are we in terms of pricing? We've moved beyond 25 basis points for March. There's now a growing expectation, and I heard it today from Bank of America's Ian Harnett, that we could maybe put 50 basis points on the table. Just to this move lower in yields today, how quickly could that get interrupted?
Well, Guy, we've definitely seen today's moves take a little bit of shine off of those March expectations for sure. I think last time I looked anyway, before I came here, it was about 25 basis points, just about fully priced for the Fed in March. But you're absolutely right. You know, we should definitely be looking at that and seeing if there are any signs for additional rate hikes, because this idea of 25 versus 50 definitely gaining traction this week. That was part of why we saw bonds sell off massively at the start of the week. And so if we get a resumption of that next week, then it's definitely going to enter the conversation once again.
Yeah, you're right. It's about 26 basis points. So we're just at that one hike level. Romaine, I mentioned it earlier, when we don't know what happens in a market, we tend to blame options. And that's what Goldman Sachs is talking about, that there's like $3 trillion worth of derivatives expiring. How much credence do you put into those kind of headlines?
Well, a lot of credence. I mean, this is a major options expiry here in the U.S. today, and that's having I have a lot of reverberations with regards to volatility. But then it comes back to valuations here. I think Guy was talking about this idea is like, do you want to be exposed to this over the weekend, particularly heading into what's going to be a busy week for earnings, a busy week for Fed policy, Fed communication here, or do you just wait that out and wait and see? Think about how much money has gone back into cash and cash-like instruments. Now, a lot of strategists we talk to, including over at JP Morgan and Bank of America, say a lot of that money is itching to get back into the market. The question is, what's the entry point? Where's the opening?
In terms of how big a shift we have seen this week, Romaine, just give us your sense. We haven't seen a proper correction, and there's a huge amount of debate around what constitutes a correction. People arbitrarily talk about 10%. But in terms of how that has affected market psychology, how much damage has been done this week?
I think it's affected it dramatically. I mean, we went more than a year without any sort of meaningful correction, at least based on that 10% barometer. You have the Russell 2000, which has basically been in correction now since early December. You have the two NASDAQ indices now down 10%, the S&P down more than 5%, and now, of course, you're looking over there where you are in Europe, and you're looking at a SOX 600 down 4.7 or something percent before I came on air from its all-time high. I mean, these are meaningful drawdowns, and more importantly, Guy, it's the idea that we haven't seen these types of drawdowns in quite some time, and that rattles folks.
Yeah, and I should point out that industrials, materials, and energy being hit really hard in Europe, and that was actually holding up pretty well. That's where the money was going. So that's an interesting development. All right, guys, thanks a lot. Romaine and Christine, good to see you. Really appreciate it. We're going to continue the conversation with Callie Cox, U.S. investment analyst at eToro. It dives into our question of the day. Tech is wrecked. Buy bonds? This is Bloomberg.
capital.com.
I think the crazy behavior, the peak of crazy behavior is behind us. I really do. I think we're now in the buy the dip mode, which the super bubbles specialize in. You don't have 2 years of buying frenzy dying overnight typically.
That was Jeremy Grantham, a GMO co-founder, saying the historic collapse in stocks is underway. And that brings us to the question of the day. Tech is wrecked. Do we buy bonds? Our next guest is going to weigh in on this. Callie Cox, U.S. investment analyst at eToro. Callie, is that it? Are bonds a safe haven now?
Yeah, well, that's the big question out there. And bonds are in just such a complicated situation at this moment. If you look at it from a retail investor perspective, the everyday investor, I mean, bonds can be a great tool to get you to your goals, especially when stocks are selling off like this. From an institutional level, bonds look incredibly overpriced, and there are a lot of structural forces at play right now. So they look incredibly overvalued, and we're having a lot of international pressure coming into them. So it really depends on what perspective you're coming from.
What do you make of the price action this week? Let's just kind of start there. We started off with bonds pushing equity markets. Equity markets now look like they're pushing bond markets. Just in terms of, as you sit here this Friday, watching the price action around you, what are you thinking about kind of where we are in the cycle, where we are in terms of understanding where we should be positioned with our portfolios? What are you thinking right now?
Yeah, so it seems like we're thinking worst case scenario here. We really went from processing this Fed policy pivot, the chance for a few hikes this year, to jumping to the fact that the Fed could hike more than 25 basis points or possibly hike at every meeting. You're seeing these cases being thrown out there. So it seems like it's been a bit of a pile on. I mean, frankly, we think the markets are overreacting quite a bit. But as you guys mentioned before, it's been a while since we've seen that 10% pullback. And 10% pullbacks happen about once every 2 years or so. So we're taking all that in stride and really thinking about, like, okay, we don't think that this right here is an economic crisis or a bull market ender. We think that the Fed is going to take this gradually. But at the same time, you really need to position your portfolios for these pullbacks that could happen even in healthy markets.
Okay, so what does that mean? Like, do you buy tech on the dips then?
Yeah, so we actually did talk to quite a few retail investors in December. We did a survey among about 2,000 investors. And, retail investors are looking to buy the dip, and that's not such a bad idea. Tech has sold off quite a bit. It makes sense if rate hikes are in our future. But at the same time, there are a lot of great stories out there. And frankly, we've been surprised that people haven't stepped in to buy the dip more. We think that that could happen, especially as levels go lower here. But we are telling our customers to be careful around tech. Tech is a great long-term story, but it may not be the place to focus right now in the short term.
Do we need to understand what tech is? Is Netflix tech? It's part of the FANG story. It's got battered overnight. This is a multi-billion-dollar company that has moved 20%, Callie. This is stuff we haven't seen for a really long time, and we're seeing it now time and time again. You look at what's happened with Peloton as well. It's clawing back a little bit. But these are big moves. These are margin call moves. These are wipe people out kind of moves. You say to be careful. How careful do you need to be?
Well, I think, again, it kind of depends on what you're thinking for your portfolio and what your goals are. Like you said, tech is a big, big space these days, and there are lots of different flavors of tech. And we're seeing that a lot of these smaller, newer tech companies with massive valuations, IPOing pretty recently, are getting hit especially hard there. Again, there might be some good stories there. There might be a chance to pick up a stock on the cheap if you really believe in the story and the management and the financials of the company. Big tech is looking a little more stable. We're seeing a lot of customers view that as more of a defensive play. And big tech's balance sheets and financials look pretty strong to us. But again, there's a wide spectrum of tech. And as we've seen, the newer tech is really leading this off. So we're saying be careful there. We're saying step in and, maybe think about what you're buying. But again, if you really believe in a story, this could be an opportunity for you.
I should point out that the S&P is like 7 points away from that 200-day moving average. We break below that, you're going to see some more momentum to the downside, no doubt. Callie, what I found interesting over the last few weeks as we processed a more aggressive Fed and more rate hikes and yields went higher is the move into value. Then it was a conversation of go buy value, go buy Europe, go buy energy, industrials, materials. Europe, industrials, energy materials is what's really selling off quite hard today in addition to tech. What does that mean? Where in the equity market then do you get value and safety?
Yeah, so I think we've progressed to the point where people are pretty much selling everything. It's selling en masse, getting rid of stuff in your portfolio. And I think that says something about sentiment. There's a lot of fear out there. But if you really step back and look at the environment, we're still in a high growth phase of the cycle. I mean, GDP for the first quarter is looking to come in at around 4 or 5% growth annually. That's very, very high compared to the averages. And in a high growth cycle where rate hikes are on the horizon, value stocks like energy, financials, industrials really thrive in that environment, even if they're not thriving right now. So, you know, we are kind of seeing that indiscriminate selling at the moment, but we think that it's not very reflective of the opportunity in this market.
Where do you think we are in 6 to 9 months' time? Again, I want to come back to a note that Ian Harnett published at Bank of America a little bit earlier on. He thinks we get a rate shock in the first half of this year, and then we have a recession panic in the second half of this year. Is that the kind of trajectory you think we might be on here?
Yeah, gosh. Well, I forgot my crystal ball today, so I'm not totally sure. But nobody is, to be fair. But, you know, it's really dependent on the Fed here. I think the biggest risk to the market, it's a fairly small risk, but the risk that really is in the market's eyes right now is that the Fed loses control. Inflation is high. Growth is kind of a question mark. We're seeing high growth right now, but we're still figuring out how Omicron and future variants are going to affect the economy. So as the Fed embarks on these rate hikes, they're factoring in high inflation, but at the same time slowing growth. So we could, you know, it all depends on how they take it. If they take it gradually and if the market economy responds correctly, then, you know, we could be in the clear here. We're still positive on equity markets, to be clear. We're still positive on U.S. stocks. We believe the Fed will be able to lead the economy into the next phase of this cycle. But there is always a risk there that the Fed does lose control and they might have to backtrack, either hike quickly or cut quickly.
Yeah, more and more am I reading about that inverted yield curve. Callie, before we let you go, we started with bonds. Let's end with bonds. The move pretty big now. The 10-year yield is down by 6 basis points. 173 is where we sit. You're seeing even a bigger move over in the UK with some real outperformance there. Where in the bond market might you want to be buying, or is it too late? Do you sell the rips?
Yeah, so that's a great question. I'd say today's action is more reflective of the fact that yields internationally are just so low that these bigger investors are coming into U.S. bonds. I mean, as we see an environment that's, you know, hopefully, you know, friendly to risk as, you know, we get out of this sell-off and as people, you know, maybe rush in and buy the dip, we're seeing a lot of opportunities in the riskier side of credit. You know, there's a lot of fixed income in general is very overvalued right now. So again, we're kind of framing fixed income as almost a tool to kind of get to your goals for our customers, you know, something to lean on when you're in sell-offs like these. But right now, if we believe that stocks are, you know, on the way to positive territory for the rest of this year, you know, we could see some opportunities in riskier credit. But right now, understandably, that doesn't look like, you know, quite the opportunity. We got to see how the market kind of shakes out here.
Yeah. Let's see how we close Friday. Let's get there first. Callie, great stuff. Thank you very much indeed. Really nice to have you on the program today. Callie Cox, U.S. investment analyst, joining us from eToro. The selling persists. The NASDAQ down 1.8%. The S&P trading at 44.32, down by 1.1%. The DAX in Germany down by 2.74%, getting hit and hit hard. But there's the S&P, as you can see, over 2 days, down by 2.2%. This is Bloomberg.
It's time for the Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. I'm Justin Morton. Bloomberg has learned that Intel plans to build what it expects to be the world's biggest silicon manufacturing site. The company will spend $20 billion on the chip-making hub near Columbus, Ohio. Intel CEO Pat Gelsinger tells Time magazine the company will use the new facility to research, develop, and manufacture its most advanced chips. Bitcoin fell today to the lowest level in more than 5 months. The world's largest cryptocurrency dropped below $40,000. It hit a high of almost $69,000 in November. Other cryptos fell too. Virtual coins have become a symbol of the retreat in speculative investments, sparked by the prospect of tighter monetary policy. And that's your Business Flash. Guy?
Thank you very much indeed. Okay, it's been another tough week for tech, pushing the S&P towards its third straight week of losses, but that isn't stopping investors from hopping into the ARK Innovation Fund. Let's talk about that slightly counterintuitive move. We bring in Bloomberg Markets correspondent Kriti Gupta.
Well, Guy, it's kind of strange to see such a sell-off they're seeing in the NASDAQ and the S&P 500, and yet people are actually going into the high beta tech space. We're asking if anyone is going to be buying the dip. Well, perhaps not directly into the S&P 500, but they're doing this into Cathie Wood's fund. If you just look at fund flows on a weekly basis, you can actually see that some of the pressure that you are seeing in the funds that have been seeing such outflows have actually reversed a little bit this week. The question, though, is this simply a kind of buy the dip move, or is this kind of a more specific target towards some of the stocks? For example, in the ARK Innovation Fund, you do have some of those biotech names as well, Chinese ADRs as well, which have started to get a little bit of a bid this week. So something to watch in the weeks ahead about whether this sticks or whether this is a short-term play.
So how does ARK compare to the S&P?
Pretty good, actually, before today. Now it's actually coming about equal. You're starting to see it on a percentage basis, reversing all of those gains where it was really outperforming in 2020 and 2021. Now just on par with the S&P 500. So we'll see if that reverses now that you actually have perhaps a buy the dip mentality.
Do we know what's happening within the fund? Is there any movement around some of the price action that we're seeing? Are they having to react to it? This is a conviction trade, not only for the management team, but also for many people that put money to work in it.
Yeah, well, it doesn't seem like they're actually, say, rebalancing their fund or anything or taking any names out, but it would be curious to see whether Netflix is actually going to change their plan because, of course, we know that the Cathie Wood ARK Innovation ETF fund is simply a very important play on the 2020 pandemic names, but it's also a huge play on China, especially those big ADRs that you saw. Alibaba, JD, for example, have caught quite a bid. So this is going to be interesting in terms of whether or not they're actually reversing their stay-at-home play names or whether this is more of a long-term bet that's not just a better bet on tech in the United States, but a better bet on tech in China as well.
Yeah, and the whole innovation point of it. All right, Kriti, thanks a lot. Really appreciate it. I know you're busy today. Kriti Gupta joining us from Bloomberg. Some breaking news for you. A nice scoop by Bloomberg on Goldman. Apparently, Goldman Sachs is looking for another way to juice some pay for its top brass. There's a new equity award. It's going to be doled out to members of Goldman's management committee. These new grants are going to be offered in place of a one-time guaranteed stock award that's been presented to other partners. And I think, the guy, this just speaks to how competitive it is within the investment banking community and how we saw compensation ratios move higher for all the banks and how we're looking at these sort of one-offs to try and retain all that talent.
Yeah, I think it's about retention, isn't it? We're about to get bonuses paid out. They're trying to make this sticky. They're trying to make some of these awards as sticky as they can to make sure that that doesn't happen. Simply paying people a huge chunk of money is one thing. Trying to sort of put some caveats around that. You've got to stick around to get some of this. You've got to make sure you stay with us. I think that's what's in many cases happening here, not just at Goldman Sachs, but also elsewhere. But I think we're going to see more and more of these stories as this issue continues to rear its head. Anyway, this is Bloomberg.
Every dollar out, every dollar in, saving you countless hours and giving you a complete financial picture for peace of mind.
With PatriotSoftware.com, accounting and payroll, keep your time and money.
Go to PatriotSoftware.com today.
Take the markets with you on the mobile app for the Bloomberg Terminal. Catch up with the curated view of the latest developments. See what's happening in world equity markets and which names are moving the index. Tap on any security to see intraday pricing, financial analysis, analyst recommendations, earnings, and more. Download the Bloomberg Professional app and take the power of the Bloomberg Terminal with you.
All right, live from New York, I'm Alex Steele with Guy Johnson over in London. This is Bloomberg Markets. You're looking at an hour into the trading session, which is shaping up to be a very brutal day. Tech leading the retreat in the equity market. Bloomberg Markets reporter Abigail Doolittle has all the market action. Abigail?
Well, Alex, it really is pretty brutal, but we're seeing something very interesting here. So moments ago, the S&P 500 down more than 1%, hitting that 200-day moving average, now off of those lows. So in this type of selling action, today does have a little bit of a feel of a panic, a real sell-off. It is, of course, options expiration